To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Friends, now let us summarize quickly provisions of section 206C 1G. It talks about TCS on foreign remittance through liberalized remittance scheme LRS. Every authorized dealer receiving an amount or aggregate of amounts of 7 lakh rupees or more in a financial year from a buyer for remittance outside India under the scheme of liberalized remittance of RBI shall be liable to collect TCS at the rate of 5%. If the amount is remitted for the purpose of education loan, then the rate of TCS shall be 0.5% on amount exceeding 7 lakhs. Seller of overseas tour program must collect tax from the buyer at the rate of 5% of the amount of package. So these are the provisions of section 206C subsection 1G. Here in this context, department gave clarification regarding the applicability of this section in case of non-resident. For example, there is a person, Mr. John. He came to India for the first time for sightseeing. As he came to India for the first time, he will become non-resident for this previous year. He is enjoying the trip and suddenly he got a call from his wife who is in America to transfer money immediately. Mr. John went to authorized dealer and transferred the money to his wife. Whether the authorized dealer must collect tax in this scenario? Department gave clarification of that. TCS under 206C subsection 1G would not be applicable if the buyer is an individual who is not resident in India and who is visiting India. In our example, Mr. John is non-resident. Why? Because he came to India for the first time and he came to India for visiting. So, two conditions must be satisfied. What is the first condition? The first condition is the individual must be non-resident. And the second condition, the individual must come for a visit to India. If these two conditions are satisfied, then authorized dealer need not collect tax from this person under this section. Friends, by this time, we all know that companies, limited liability partnerships and partnership firms must mandatorily file return of income under section 139(1) of Income Tax Act. Along with these three SSEs, any other person whose gross total income including exemptions under capital gains exceeds basic exemption limit, if the SSE have deposited into current account more than 1 crore, if foreign travel is exceeding rupees 2 lakhs, if electricity bill is exceeding rupees 1 lakh, if you are resident ordinarily resident and if you are having foreign asset in foreign country, then you have to file return of income mandatorily under section 139 subsection 1. With respect to compulsory filing of return of income, CBDT issued notification through which central government has introduced Rule 12AB in income tax rules regarding some new conditions for furnishing the income tax return in respect of persons other than companies, LLPs and firms. It means anyway companies, limited liability partnerships and partnership firms must file their income tax return compulsorily. We are talking about other category of persons, other category of SSEs, those who has to file return of income compulsorily. What are those? Let's have a look into it. Number 1, a person carrying on business if his total sales, turnover or gross receipts exceeds 60 lakhs during the relevant previous year. The second category is a person carrying a profession if his total gross receipts from profession exceeds 10 lakhs during the relevant previous year. Here, Act is talking about profession. It did not specify whether it is specified profession or not, which means if any SSE other than company, LLP, firms, if the SSE is carrying out the profession and if the gross receipts from the profession is greater than 10 lakhs, then the SSE must file the income tax return compulsorily. Third one, a resident individual whose age is greater than or equal to 60 years, which means we are talking about senior citizens. At any time during the relevant previous year, the aggregate of TDS and TCS is greater than or equal to 50,000 rupees during the relevant previous year, which means, for example, there is an SSC whose age is 65 years, and for this SSC, the TDS amount and TCS amount in combination is exceeding 50,000 rupees. In that situation, he has to file his return of income compulsorily. If it is exactly 50,000 also, he has to file his return of income, and this 50,000 limit is for the relevant previous year. During the previous year, if the TDS amount and TCS amount combinedly is more than or equal to 50,000, then that particular person must file a return of income compulsorily. Next, the fourth one comes any other person, which means here we are talking about person other than senior citizen. In this scenario, if the aggregate of TDS and TCS is greater than or equal to 25,000 during the relevant previous year, then that particular SSC must file return of income compulsorily. Next, a person having a savings bank account and deposit in one or more savings bank account of a person in aggregate is greater than or equal to 50 lakhs during the previous year. In this scenario also, the SSC must file return of income compulsorily under this act. So, to summarize, what is the amendment we got? The following categories of SSCs must file return of income compulsorily. The first one, person carrying on business and his total sales or turnover or gross receipts exceeds 60 lakh rupees during the relevant previous year. Second one, person carrying out profession, his gross receipts from profession exceeds 10 lakh rupees during the previous year. Third one, a resident individual whose age is greater than or equal to 60 years and the combination of TDS and TCS during the relevant previous year exceeds 50,000 rupees or exactly 50,000 rupees also, he has to file the return of income. And the next one, when the person's age is less than 60 years and the TCS and TDS combination is greater than or equal to 25,000, he must file the return of income. And the last one, if the deposits in savings account is greater than or equal to 50 lakhs during the previous year, he must file the return of income under this act. So, these are the categories of people who has to file the return of income compulsorily. So, companies, LLPs and partnership firms must file the return compulsorily. Along with them, we are having some other categories specified in section 139(1). Along with those categories, the government included the following categories to file return of income compulsorily. Friends, by this time, we all know that section 139AA makes it mandatory for every person to link his Aadhaar and PAN. If the SSC fails to intimate Aadhaar number by 31st March 2022, the PAN allotted to the person would be inoperative. And we also know that if the intimation of Aadhaar number is made within 30th of June 2022, the fee will be rupees 500. And in all other cases, the fee will be rupees 1000. Further, there is a rule 114AAA which provides that if PAN becomes inoperative, why it becomes inoperative? If we are not linking Aadhaar with PAN, our PAN number will become inoperative. What are the consequences if the PAN becomes inoperative? The person would not be able to file the return using the inoperative PAN. The pending returns will not be processed. Pending refunds cannot be issued in inoperative PANs. Pending proceedings, as in the case of defective returns, cannot be completed. Tax will be required to be deducted at higher rate. Tax will be required to be deducted at higher rate as PAN becomes inoperative. All these are consequences when our PAN becomes inoperative. And one more thing we have to remember here, if PAN becomes inoperative, it becomes difficult for the SSC to fill his KYC whenever he is going to banking channels. For example, if we want to take a loan, PAN is inoperative. If we want to open a savings bank account, PAN is inoperative. So all these consequences will happen whenever the PAN becomes inoperative. Why it becomes inoperative? It becomes inoperative just because of not linking Aadhaar with PAN. In this context, department through circular gave clarification with respect to relaxation of provisions of Rule 114 AAA when PAN becomes inoperative. Department clarified that the impact of this rule 114 AAA would come into effect from 1st April 2023, which means during this period, 1st April 2022 to 31st March 2023 would be the period where these negative consequences of inoperative PAN will not be applicable. This rule 114 AAA will be applicable only with effect from 1st April 2023. However, the taxpayer would be liable to pay the fees in accordance with 234H. It means during this year, 1st April 2022 to 31st March 2023, the late fees under 234H will be applicable. But the rule 114 AAA will be applicable only with effect from 1st April 2023.